This episode of Macro Mondays aired live at 12:30 p.m. on Monday, the 24th of February, 2025. Tune in Mondays at 12:30 p.m. UK time to watch Macro Mondays live.
Hello and welcome to another episode of Macro Mondays. My name is James Brodie. I'm Head of Learning and Development here at Onyx Capital Group.
And I'm James Todd, Direct Trader here at Onyx Commodities, giving you insight from our trading floor.
Today we'll be looking at key market trends and charts. First of all, we'll look at the data. We'll discuss the sudden deterioration in US data. PMIs, flash PMIs and consumer sentiment came out sharply weaker on Friday. Same in Europe, PMIs coming out weaker, but they have rising inflation there. That's the worst combination for central bankers.
Looking to the east, and Chinese yields have had a very strong week or so, keeping up pace with the tech stocks that have been booming over in China. In the US, however, equities have had a pretty poor week and they continue their downward trend, so we'll be looking at that. And finally, we'll be looking at the election in Germany as the Conservatives have won there.
So firstly, let's look at the US data. On Friday, we had the flash PMIs. And service PMIs in the US fell sharply, estimated to come in at 53.0, came in at 49.7, contraction and the lowest level in 2 years. Meanwhile, the composite PMIs, so service and manufacturing combined, that fell from an estimated 53.2 to 50.4. So sharply lower than expected. And you can see here from the chart, this is the 10-year government bond yield. You can see yields clearly trending lower and sitting right in a key 4.4 level. I'd expect it to break here with the data coming out weaker, and we'll see more money flowing out of equities and into bonds. But we'll come on to the equities in a second.
Yeah, always worth paying attention to the services sector in the US that's obviously so large, and to see both the services and the composite, obviously PMIs failing to meet expectations. It's a worrying sign, and it's, not an isolated piece of information, as we'll come on to discuss.
That's a great point. Service sector is about 3 times larger than the manufacturing sector. It'd been the manufacturing that had been weak for over 2 years, but now we're suddenly seeing that moving towards the service sector. If we move on to Friday's University of Michigan Consumer Sentiment Index, this plummeted and came in the lowest level since November 2023. Headline falling from 67.8 to 64.7. This was a sharp fall across all demographics, and what we've seen, again, it's a sharp reversal from the post-election euphoria. You can see here, again, from the chart, how across all areas, sentiment is moving sharply lower. Within that, you can see consumers are hurting. Financial situation is the worst since 2013. And we're also seeing inflation expectations sharply higher. So this is really what's hurting the consumer. They as well are seeing higher inflation and worse finances. And so again, if we look at a chart here, this is the Citibank Economic Surprise Index overlaid with the US 10-year yield. You can see the white line, the Economic Surprise Index. You can see data's coming in lower than expected. This drags yields lower, also drags the dollar lower. The dollar peaked basically on Inauguration Day. You can see data's coming in lower than expected in the US, and we're going to see it's vastly different what we're starting to see in China.
Yeah, I think, referencing back to the consumer confidence and the financial overall wellness of US middle classes, it seems pretty worrying, and it's likely to continue that way for a while if you are going to be seeing sort of a low interest rate and a high tariff environment. These things are going to be, leading to inflation directly, and they're also very well publicized. So consumer confidence, I think it's very understandable that in the short run, this is going to continue to be, a worry for many US consumers. In terms of the overall financial situationship as well, it sounds as though the tariff plans are very much geared up in Trump's agenda, at least, to be a long-term solution to the US middle classes issues. This is not a short-term solution, so I think you may well also continue to see hardship in the short run there.
And of course, if consumers are finding financial hardship, what do? They put their hands in their pockets, they stop spending. We've seen retail sales fall sharply recently, and we're seeing discretionary spending falling as well. We'll see slides on that in a second. What we also had last week was billionaire hedge fund manager Steve Cohen said he's now negative on the US economy, pointing to tariffs, tighter immigration laws, and government cost-cutting led by Elon Musk. And on the tariff front as well, last week, Donald Trump floated the idea of 25% tariffs on cars, drugs, and chip imports. So the dollar's turned lower, dollar index lowest level since mid-November. And Treasury Secretary Scott Bessent said Trump's policy will be disinflationary. He's already said they want to target 10-year yields lower. That, of course, will bring the dollar lower. Disinflationary, again, we're seeing the effects of this coming into financial markets.
Yeah, it would make US exports more competitive, seeing the dollar drop lower, but also when you think about the purchasing power of the average domestic consumer, obviously that has a negative impact.
Yeah. Interestingly, having said the dollar is weaker this morning, we're seeing a bit of a levelling off in euro dollar around the 105 level. Interestingly, the election in Germany, we'll discuss that in a second, but we're not seeing any follow through with the euro higher. So interesting week there for euro dollar. Moving on to equities. We've touched equities quite a bit recently. S&P is now at critical levels. We're seeing a double top there. Friday had a big negative day. S&P closed down 1.75%. What's really interesting, though, is seeing a divergence. We're seeing retail buying continuing to chase it higher. We've seen record buying over the last few weeks. But as you see from the chart here, we're seeing the smart money, the hedge funds continue to take money out of equity market. You can see from this chart here, the top three largest retail buying days in the history of US equities all came in the last 20 days. Meanwhile, 89% of US investors view equities as being overvalued. That's a report coming in despite having the lowest levels of cash in 15 years. Bank of America Fund Manager Survey is stating 89% of investors seeing equities as overvalued.
So I guess here's the question. If US investors are seeing it as overvalued and the smart managed money is reducing its length, getting shorter, why are we seeing such huge retail flows coming into US equities?
Again, it means if equities do go lower from here, they have their biggest position, then it suddenly becomes a pain trade because they're making bigger losses on the way down than they made on the way up. So it's absolutely critical levels. As we'll see from a chart in about 2 slides time, the Nasdaq, it's turning lower. It can't break new highs. So again, that becomes critical levels for the retail traders. Interesting point as well, Warren Buffett and Berkshire Hathaway have actually been net sellers of US equities for 9 consecutive quarters now. We're also seeing weak S&P consumer discretionary sector. It's wiped out all its gains since the end of November, and this comes back to the fact that consumers we're seeing are largely tapped out.
Yeah, they don't have excess money to be spending on these sort of luxuries as they are perceived. And particularly if you look at the US, obviously there have been, wildfires in California, etc. But more recently, you've had a very cold snap. I think there's a lot of uncertainty about the wider aspects of life and, significant spending having to go on things like housing, rent, mortgage payments, etc. does mean that the sort of discretionary sector is going to be coming under fire as people have that increased risk premium built into them and have less money to be able to spend anyway.
Yeah, and we're seeing also from the employment data, record numbers of people are being forced to take second and third jobs. So it's almost becoming a 2-tier economy. Those with the stocks and the assets have done particularly well in the last few years, but those without are getting crushed by inflation.
Yeah.
So here we have the chart of the Nasdaq. That closed down 2.1% on Friday. You can see it's not able to break through clear resistance, sort of triple top level there. And you can see it's sitting right on support. We're seeing stocks like Nvidia struggling. Meta had a sell-off, a sharp reversal from its 20 consecutive days higher. Interesting time for equities now because it hasn't got the follow-through buying from the funds that we've seen, the institutional investors. It's just the retail, and demand is starting to evaporate and moving towards bond market. On to Germany. Over the weekend, we had the elections. The far-right AfD had been rising. There was concerns that they may take a majority. They actually came second in the polls. The German Conservatives are celebrating the win. But Merz has said this morning that there's a seismic shift in transatlantic relations. You can see Europe is starting to step away from the US with Donald Trump's recent remarks. Interesting developments there. Economic data, though, remains weak in Germany. And here's a chart here. Actually, this is the euro-yen, a weekly chart. You can see how second half of last year, it was all about the yen weakness. People were saying about how the currency was going to collapse. Well, that's reversed. The Japanese yields are surging. Inflation is stronger there. The data is stronger. Central banks hiking rates, and you can see now euro-yen is sitting on a critical support. If that breaks, then we're going to see a more aggressive move lower.
Yeah, I think it's always interesting to look at these elections and see, how much of the voter pool goes to these sort of very contrarian parties, these populist people, whether it be on the far left or far right, doesn't really matter. I think it's always a sign of resentment towards incumbent political parties, etc. And there's clearly a huge amount of resentment amongst the German voting public. Data has been consistently weak in German manufacturing, etc., for a while. I think that's really translating into unhappiness, etc. You didn't see the AfD seize a majority, but they've still done very well. France has obviously had, far-right success under Le Pen in sort of relative terms, that they're still gaining a lot of support, I think, due to a number of reasons, but economic uncertainty and unhappiness is definitely...
And immigration, we've seen that in Austria and Holland.
Absolutely. But it's always interesting to try and analyse the outcomes of these sorts of elections. And it seems as though there's not too much of a consensus, as far as we can tell, on policy changes that are going to be ensuing following this election, but it does seem as though there's going to be some pressure being put on to make sure that energy prices, etc., are capped and lowered in Germany. And I think this is one of the leading costs in manufacturing there. So if energy prices were to perhaps go down, if you're seeing fewer Green Party seats in the Parliament there, you might see short run lowering of prices, and hopefully in the long run for the Germans, you see increased competitiveness in manufacturing there.
It's definitely struggling as an economy, though. We need to see some turnaround there. On to central bank moves last week. Largely expected, the RBNZ cut rates 50 basis points. Interestingly, the market's still expecting another 78 basis points of cuts from them. Again, historically, RBNZ of the G10 countries typically had the highest interest rates, but now the market's projecting in a year's time, base rates there will be at 2.96%. Only Eurozone and Japan and Switzerland would be lower. RBA cut 25 points. The market was looking for another cut at the next meeting, but we've since had some strong Australian employment data out last week. 44,000 jobs created, market only expected 20,000, and unemployment rate remains resilient there at just 4.1%. On to China. We've discussed recently the Hang Seng Tech Index. It's really surged since DeepSeek announced their AI, OpenAI. Hang Seng Tech surged 6.5% on Friday. Interestingly, when the Nasdaq was down over 2%, starting to see hot money flowing into China. Friday as well, chip maker Cambricon hit limit up 20%. Alibaba's jumped 50% year to date, but still with a PE of only 13.1. We've mentioned US stocks, record high price to sales, price to book ratios, only higher PE ratios in 2000. Big move here in Chinese equities, but they're still cheap.
Yeah, it's still supported, and obviously, yeah, there's that discrepancy in perhaps US companies being overvalued and Chinese being undervalued, and it seems as though the market is waking up to this.
Yeah. Also, house prices in China came out last week, down 5% year on year, but the rate of descent is falling. So there's a lot of optimism there, money starting to come back in and looking at particularly new houses. The other key piece of data positive out of China, not so much data, but financial market moves here. Yields are surging higher. Here is the Chinese 2-year interest rate swap, and you can see since beginning of January, yields surging higher there. The concern about deflation and the slowing economy has reversed. Of course, it's been supported in the last few weeks by Hang Seng Tech, but certainly a change in sentiment here. And it ties in, interestingly, with the sudden weakness in US data.
Yeah, I think, we've clearly had a difference in regime between 2024 and the tail end of 2024, where everything seemed doom and gloom, to now. There are definitely, positive offshoots, and I think sentiment is definitely coming back. And yet again, when you see momentum flipping, people can hop in. So you might see things coming on parity a bit with China versus where things were in 2024.
Also, of course, as soon as markets trend, then the trend following traders and, of course, the trend following algorithms jump on board. And it seems we've had a pretty large change in sentiment in the last few weeks. On to oil.
Yeah, so Brent is seemingly, almost trapped in its levels at the moment. We're sort of around the sort of $74, $75 mark. One thing I would say, there are a lot of geopolitical factors that are ongoing in the background. I think it was said today that Trump is, very much considering sanction relief on Russia being on the table if they were to end the war in Ukraine, etc. You've got Middle East tensions ongoing. Is that bullish? Is it bearish? I think it remains unclear exactly what the wider political situation is going to be in the Middle East in 3 months, 12 months time, etc. So the market sort of does react a bit to these news, but overall I would really say one of the things we're experiencing is headline fatigue. People aren't as jumpy at headline news anymore. I think traders are seeing every headline, and you see any surge and you just think, what's the point? Because it seems to revert back at the moment. Fundamentals don't seem to have changed too much. So I could see, in one regard, this period of headline fatigue maintaining and a relatively low volatility environment for a while, until the market sort of made up its mind, and until policymakers have made up their mind as to whether Russian barrels are going to come back on without sanctions, etc. One thing that's always worth noting, though, is that we're now entering International Energy Week in London, which is, a big week of meetings and conferences, etc. It's been known to have some funky moves in years gone by, so you might see a bit of volatility, but I would expect that would be more felt on a product side, so whether it be sort of gasoline, distillates, etc. If you were to see anything, it would probably be that rather than crude. I would anticipate you'd see some moves on. But yeah, it's sort of play on, I would say, as regard to Brent.
Yeah, one thing I can't help but think is the backdrop has changed this year. With Trump in power, he's made it clear he wants the oil price lower to help bring down inflation and stimulate growth. And he'll do whatever he can to support that. You can see from the chart, Brent sits on key long-term support, trend line going back to 2000. You can see volatility's got lower and lower and lower. We had a break higher. But if that trend line breaks, then the previous lows of last year come in around 71 level, and it briefly went under 70. But any break below there, if it happens, we'll definitely see stops getting triggered and a faster move lower. On to Japan. So Japanese CPI beat expectations, coming out at 4% year on year, estimated to come in at 3.6. Big move higher. This is the one country that actually wants CPI. Japan had years of deflation after their 89 boom. So they're actually looking for CPI higher. 10-year yields have jumped to the highest level since 2009. Some concerns: if yields go up too quickly, BOJ Governor Ueda said they would purchase bonds quickly if bond yields rise too sharply. Of course, their concerns. BOJ, of course, is the largest holder of Japanese government bonds, JGBs. They don't want yields higher too quickly. But, of course, they have the world's highest debt to GDP at 270%. But as yields go higher in Japan and they're going lower in US and Europe, of course, that's going to support the currencies, support the yen. You can see here, again, a favorite chart. The dollar yen is the orange line and the 2-year interest rate differential is the white line. See, it's pretty highly correlated. Of course, it's not interest rates are the only thing that move currencies, but for G10, it's the predominant driver. And you can see definitely downward pressure on dollar yen there. Interesting point as well, Japan has 4% inflation and interest rates at 0.5%. US CPI is 3%, UK 3.7%, Eurozone 2.5%, and China 0.5%. So Japan has the highest inflation, yet by far the lowest interest rates. So I think it's another reason why we'll see more normalization of interest rates and the currencies. Onto the UK, higher inflation and lower growth, stagflation. So UK inflation rate jumped from 2.5 to 3%, estimated to coming up at 2.8. So the market was expecting it higher. Jumped aggressively higher, highest level in 10 months. And PMIs, on the other hand, sharply dropped, especially employment, sharpest drop since November 2020.
Yeah, I think, inflation being high is a surprise to nobody, and the lack of added productivity in the UK's economy has been, a cause of concern for a while now. I think you're seeing more and more, anecdotally, more and more firms are taking people back to the office for sort of 4 or 5 days a week, scrapping work from home. I'm not sure that that's going to be sufficient in order to actually provide the added productivity that the UK needs. And, we're seemingly, as you say, in a period of stagflation, which is policymakers' worst nightmare.
And what we've got in the months coming ahead is the impact from the new Labour government's tax rises, which is going to hurt employment. Favourite trade, I guess, is shorting sterling against the yen. The dollar's going down, it's struggling at the moment, but I prefer to short sterling as a currency than yen would be the trade I would take on the other side of that. Very weak French PMIs. French composite PMI, flash PMIs fell. Estimated to come in at 48.0, came in at 44.5. Weak domestic demand, weak orders, the largest reduction in jobs in nearly 5 years, weak pricing power, and rising input costs. You can see here, this is the employment component of the French PMIs. Again, just looks really weak for France.
Yeah, terrible.
This is also bad news for euro. Again, euro yen. We've seen the chart earlier. It's trending down.
Yeah, I think we've been saying it for a while, but we're seeing a bit of a restructuring of the sort of economic power balance within Europe, and it's Germany and France that are really struggling in terms of growth and productivity, etc. Whereas, if you look further south, countries that were particularly struggling, in the mid to late 2000s, the sort of pigs countries, as they're often referenced, things have been looking, better in Spain, Portugal, in Greece as well. So I think, slowly as things go by, if this momentum keeps going, you're going to be seeing these southern economies that used to be underly productive, actually sort of coming closer to parity with France and Germany.
Yeah, and who'd have thought this in the Greek crisis? 2011, 2012, again, as you say, it's the Mediterranean countries that were crippled and really weak. It was Germany, particularly, the economy that kept Europe afloat, and now it's completely reversed.
And I think obviously it's worth, paying particular attention to the euro, as we often do, because if you're talking about competitiveness of exports, etc., these countries all have to work as one. So one of the key aspects for the turning of the 2010s, etc., was everyone was saying that the German currency, being the euro, was very undervalued. So it made German exports so competitive, etc., and that really supported the economy. If you're seeing these southern economies, the Mediterranean economies, increase in their productive potential, etc., that's going to mean that the euro isn't so undervalued, and Germany won't be able to just manipulate the price of the currency as directly. So yeah, you have to consider all things policy making.
Interestingly as well, the DAX, we highlighted that, how the German economy had been weak, yet the DAX had gone up to all-time highs. That reversed sharply last week. That's going aggressively lower. The other point, I think, with Europe, Eurozone area, is just the bureaucratic mess. So if you look at when Trump put the tariffs on Canada and Mexico, within a weekend, they reversed their policies and Trump was appeased. But it will be impossible to get that in Europe if we see more tariffs coming. Onto gold. Interesting that there's been huge demand to buy gold and basically repatriate it back to the US. We're seeing record purchases out of Switzerland as well as, of course, the UK. Here you can see from the chart, gold in COMEX vaults has suddenly gone sharply higher. Interesting point with gold. Its most significant drawdowns over the last decade is 22% versus Bitcoin, for instance, which has gone down 82%, 71%, 54% and 75% since 2017. So gold, it's up over 40% in the last year and it's trending higher. We're seeing it's getting to quite overstretched levels. Momentum's falling, but it's a much less volatile investment than crypto, for instance. It's also been outperforming the S&P since 2018. The S&P, of course, also had a 35% drawdown in 2020 and a 27% drawdown in 2022. So it's a consistent winner, lower volatility than other assets.
Yeah, I think from a trading perspective, as we've said before, the momentum is often there, and so you can see herding. That can support things when it's in an uptrend and finding support around the all-time high levels. From US policy perspective, it seems as though there definitely is going to be attention paid to the gold and physical gold as well. Musk and Trump are going to be auditing the Alcatraz? Fort Knox, sorry, yeah. The Fort Knox reserves of gold there, and making sure that the physical gold is actually there, which hasn't seemingly been done for many, many years. And yeah, so from that physical perspective, there's clearly attention being paid to it. You're seeing central banks in it. You're seeing momentum trades. So it's a supported asset.
Also, as we've seen, if asset managers have got such small positions in cash and I think equities are overvalued, clearly they have a lot of investment in gold as well. Lots of conspiracy theories going around, the gold standard and banks being forced to repatriate gold to the US as well. But one thing's for sure, the movements of gold into COMEX are surging and the price continues to trend higher. The next chart you can see, although it's trending higher, if we look at the RSI Relative Strength Index, it is at significantly overbought values. The momentum is weakening, but it is still in an uptrend. Again, the market doesn't have to pull back. It can unwind its momentum by going sideways, but clearly there's a lot of interest in gold, and we'll see more buying for sure if equities continue their recent downward move. Onto crypto. President Trump last week said he'd signed executive orders to end Joe Biden's war on Bitcoin and crypto. He said, "We've ended that war totally. The war is over." Interestingly, over the weekend, though, we saw Ethereum fell 6% as Bybit confirmed the exchange was hacked for $1.4 billion. You can see from the chart here, Bitcoin, it's been in a sideways range for several months now. Really, the support comes in at 91,000. Really, there's a double top about 107,500. It's going sideways. Again, it needs to break above 107,500. If it does, you'll see more buying coming in. A break below 91, a close below 91,000. Risk management, then you'll see a sudden move lower as stops are triggered and certain number of longs exit the market. Central bank pricing for the next 12 months. We've had a significant amount of moves, particularly over the last 6 months. The market's still looking for nearly 2 cuts from the Fed, over 3 cuts from the ECB. It's just 57 basis points from the Bank of England. Again, that's precarious there. They have inflation, but they have a weakening economy. Still 78 from the RBNZ, 44 RBA, and the market's still looking for another 35 points of hikes by the Bank of Japan. Again, that will strengthen the yen. So a couple of charts to finish with. Firstly, Meta, it had, I think, 20 consecutive days of higher closes. That has reversed sharply at the end of last week. Again, the short-term trend here, the 8-day moving average, that's trending lower. And the other chart that's interesting here is the Sensex. Peaked in September 2025. It was a long and steady uptrend, but now is in a clear downtrend. It's broken the trend line. We've got lower peaks, lower lows. Again, risk is being taken off.
Yeah, the momentum's out of it. And as you say, it's, if you were to draw your lines on it, you see downward momentum here.
So it's an interesting couple of weeks we've had in markets. We've had weaker data out of the US, unexpectedly weaker. Europe continues to be a laggard, but we're seeing signs of growth in China. Tech stocks are surging, yields are going higher. Meanwhile, we're starting to see some really concerning signs from US equities. What do we have for the week ahead? Tuesday, we have US house prices and US consumer confidence. On Wednesday, Australian CPI. Again, the key part of that the RBA looks for is the trim mean. So keep an eye on that. The market's on tender hooks, looking for another cut at the next meeting. German consumer confidence, US new home sales. Also on Wednesday, a key one, Nvidia earnings. Nvidia unable to break new highs since DeepSeek. It also had a sharp sell-off on Friday. We could see some volatility in that. Thursday, US durable goods orders. Probably more important is Japan retail sales and industrial production. Also Tokyo CPI, keep an eye on there. Probably the key data of the week, Friday, US inflation from the PCE deflator. That's the Fed's favored measure of looking at inflation. But really the market's less focused on data now, more on basically actual price movements.
Yeah, absolutely. And
we're seeing more volatility in markets. We're seeing stops getting triggered.
It's going to be an interesting week for sure. And, I'll be paying particular interest to the Nvidia earnings because, this is the highest performing thing. And it's such a large part of US equities now is this sort of tech potential bubble. And seeing Chinese tech doing so well, I'm going to be very interested to see what the reaction to Nvidia's earnings report is.
And what their outlook is.
Exactly.
So thank you for joining us this week on Macro Mondays. Please do like and subscribe. Have a great week and we'll see you next week. Thank you very much.
Thank you.
The true heartbeat of the global economy, the financial oil market, has remained out of reach for most until now. Introducing Onyx Markets, the first platform to bring personal investors into the ecosystem that sets wholesale oil prices around the world. This is where the real economics of energy begin, a market that shapes so much of our everyday lives. Onyx Markets levels the playing field. Access live, tradable numbers from the industry's leading provider of financial oil market data. Whether you're a personal investor or a global corporation, low cost, transparent, and empowering. For the first time ever, you can trade global oil benchmarks like dated Brent, Northwest Europe shipping fuel, and US Gulf Coast propane through spread betting and CFDs. Hedge with precision, trade tax efficiently, and gain unparalleled transparency. Supported by the world's largest liquidity provider in the financial oil markets, Onyx Markets also brings you insights from industry-leading analysts, detailed reporting, and expert-led education to help you navigate this market with confidence. Onyx Markets, the power of the financial oil market now in your hands. Start trading today. Visit onyxmarkets.co.uk.